Good afternoon, everyone, and welcome to a webinar, Introduction to Trading Short-Term Price Action on Nadex. This is part 2 of a 2-part series. If you missed the first part, it is available both on the Nadex website in the Learning Webinar section. You go to the archive and it's posted there. In fact, a recording of this session will be located there as well. You'll also be able to find it on the Nadex YouTube channel. So if you just go to YouTube, look for Nadex, you will find the first part of this series posted in the video section, and a copy of this session will also be posted there. So I just wanted you to know that you can go back and catch that or rewatch it, as well as review this one when we're done. So an introduction quickly. My name is Todd Rich. I am with Nadex. I am head of education there. And let's jump into it because we've got quite a bit to cover today. So before I get into anything, I do need to share this disclaimer because this webinar, as are all of our webinars, are sponsored by our compliance department, where I must share that trading involves risk and may not be appropriate for everyone, that any trading decisions you make are solely your responsibility and at your own risk, and that this is an educational session. Please do not construe anything I say as a buy or sell recommendation. I am doing this for your education purposes. That'll actually become much more relevant at the end of this session when we do what I like to call a little bit of off-roading, where we will jump over to the platform. We will walk through some very specific examples. When I'm clicking around on there, it will be in a demo environment, and I'll explain that in a bit as well. But I'm not making any trade recommendations. All right, so what are we going to cover today? And there are a lot of folks on this call, and some of them very well might be brand new, or many people might have missed the very first session of this little 2-part series. So I am going to do a brief introduction to Nadex, and then I'm going to walk through the 2 products. Most people come to Nadex for binary options. And I love our binary option products. I think they're absolutely incredible and they are unique, but it's nice to know that we've got other alternatives as well. I am going to cover knockouts first. The reason I cover knockouts is I believe once you understand all the concepts around knockouts, understanding call spreads will be simple. It will be super simple. So I like to do knockouts first. And then, as I like to say, a very practical demonstration. Show me. My mother was born in Missouri. She grew up in the great state of Missouri, and it's the show me state. So I am going to show you. And we will jump over to the platform and we'll do a little demonstration. So let's get into it. Let's do a brief. It's kind of funny is I don't really ever do a brief introduction of myself and my background. I probably ought to. I'm a former floor trader for a number of decades. Then I went to the exchange space. I worked for a very large futures exchange out of Frankfurt, Germany, called Deutsche Börse. They had Eurex. I then was over at Boston Options Exchange and the New York Stock Exchange for a number of years before I went into the retail space and ended up over at E-Trade. I only joined Nadex about a year and a half ago, but I bring all this experience from both the trading world, from the floor, electronic trading, into the exchange space and then to the retail brokerage space. And it sort of plays into who is Nadex. Nadex is an acronym. It stands for North American Derivatives Exchange. Of course, everything in our industry has to be an acronym. But what's really important is that we are a proper regulated exchange. And the designations, whether it's a contract market or a clearing organization, technicalities, what really matters is we are regulated by the CFTC. It is the same regulator that regulates very large futures exchanges like the Chicago Mercantile Exchange, the CME, or even ICE, the Intercontinental Exchange, who bought and owns the New York Stock Exchange. Now, that really comes into play heavily when we talk about binary options, because a lot of people find binary options out on the internet, and there are some other providers that are offshore, but they are not regulated. And in that regard, if you had any challenges, problems, or wanted some type of recourse, that would be a bit of a challenge when there is no one to go ask recourse from. With Nadex, we are regulated. We have to adhere to all the rules, regulations, and laws of the United States, and we are regulated by the Commodity Future Trade Commission. Now, what is it that Nadex offers? And it really is opportunities for the retail trader, right? And what does that mean? And that is, I mean, our marketplace, true retail traders. And it's one, there's a low cost of entry. There's a low cost entry. You don't need thousands of dollars or tens of thousands of dollars to access price action in the markets. You can do so with small quantities of money. And everything we've got, all of our products, whether it's binary options, knockouts, or call spreads, have clearly defined risk. So you know what you could potentially lose or potentially make before you even get into the trade. So that's really what Nadex offers. And that's who Nadex is we are a proper regulated exchange in the United States that offers products specifically for the retail trader. Now, let's talk about knockouts. Right. By the way, I do want to tell you that you can ask questions as we go, because now that we're going to start getting into the meat of it, please, you can type questions in as we go. I will be monitoring that. I will try to answer them as we go. If I miss them, I will go back and try to review them before we go through the platform session. And then I want to make sure I cover any questions or things that people would like to see specifically when we go to the platform section. So this is a bit interactive. You've got me now, and this is live. And so if you've got any questions, please feel free to type them in. And the likelihood is, if you have a question, someone else probably has the question as well. So I want to make sure that everyone gets the most benefit out of getting this while you're here with me live. So what is a knockout? A knockout, it's a contract, right? It's a contract, and it trades within a set range, right? And that range has got two price levels. The price levels, we often call them the floor and the ceiling. So there will be a price level that is low, and that's the floor, and there will be a price level that is high, that is called the ceiling. It seems pretty straightforward. Now, the contract, what you're trading, and let's use gold as an example. I'm just going to pick gold out of the air. If you the price of gold, a gold knockout, it will trade between the floor and the ceiling, and the contract itself will move directly in line with the underlying market. In industry terms, it's referred to as a Delta 1 product. You are trading specifically the price of gold futures. That is what you are trading, the price of the gold futures. So unlike a binary option, and when you go back and look at binary options where you're trading the probability of an event happening or not happening, with a knockout, you're simply trading the price of the underlying. And it's in any other market you're probably familiar with, like the stock market. If you thought the price of something were going to go higher, you would buy it. And if you thought the price of something were going to go lower, you could sell it. Now, I know that selling concept gets a little tricky for some people. They say, how can I sell something if I don't own it? And really what you're trading is the price of the underlying. You're not trading the physical underlying itself. And so when you sell, you're simply taking a short position, and you are looking for the price of something to go lower so that you can potentially profit if it did go lower, and you could, say, buy it back at a lower price. So a knockout, it's a contract. We give you a clear range. There is a floor, there is a ceiling. the price of the contract, and I use gold for instance, will move up and down, and you can buy or sell. And if you think if it's going to go higher, you would buy. If you think it's going to go lower, you would sell, and it moves directly in line. Right? So it's very intuitive. If I thought the price of Facebook were going to go higher, I would buy it. If you wanted to take a short position in the stock market, you could short sell, but short selling stocks, very difficult. There are restrictions, obligations with our contracts because everything's got clearly defined risk. You can simply go short and sell to look to profit if it's going to go lower. Now, how do they work? A knockout will expire in one of two ways. All right, we've got price and time. There is a price triggered settlement and there is a time triggered settlement. Now, what do I mean? A price triggered settlement is if the price of the underlying touches either the floor or the ceiling. So let's talk about that. If I thought the price of gold were going to go higher and I bought it, and I know it's going to trade between the floor and the ceiling, if the price of gold touched the floor of the contract and I had bought it, I would get knocked out of the trade. It would settle, it would be settled based on price, and I would experience maximum potential loss. All right, I would experience maximum loss. I bought it, it went and touched the floor, and I got knocked out for a loss. Now, if I bought it and it went up to the ceiling, I would get knocked out of the trade. That's why they're called knockouts, because it touched the ceiling, it triggers price triggered settlement. I would get knocked out of the trade and I would experience maximum profit. All right, so that's it, a price triggered settlement. You can buy or sell a knockout. It will trade between the floor and the ceiling, and it will move around between the floor and the ceiling until it touches either the floor or the ceiling, at which point that knockout contract is settled. And it settles because it got triggered by price, either by touching the floor or the ceiling, and you get knocked out of your trade. So if I thought the price of gold were going to go lower and I sold it and it went and touched the floor, boom, I'm knocked out, maximum profit, thank you very much. If I sold it because I thought gold were going to go lower, but it touched the ceiling, boom, I got knocked out. It didn't do what I thought it was going to do. I was wrong, but I'm knocked out and I experience maximum loss. Now, the question is, what happens if it doesn't touch the floor or the ceiling? It will eventually settle at the end of the week, and I'll get into that in a second. But if it doesn't touch the floor or ceiling, it will settle at a time. We give you a settlement time for the contract, and then it would be a time triggered settlement. So it just doesn't go on forever and ever. In fact, we have weekly contracts, and you could trade them all week long. And then at the end of the week, if any of the knockouts that haven't touched the floor or ceiling, we will settle them at that moment in time. Now, at that moment in time, the question is, well, did I make or lose money? And the way it works is, if you buy a knockout and the price goes higher and time settles it, you would experience a partial profit. If you bought it and it went a little lower and it time settles, you would experience a partial loss. So you would, the way you're going to really go into a knockout initially, just initially, and we'll talk about managing your position later, but initially you buy or sell a knockout. If it touches the floor, you're knocked out. If it touches the ceiling, you're knocked out. If it doesn't touch either and it settles at the end of the week and you get a time triggered, your profit or loss would be the difference between where you bought it or sold it and where it settled. Otherwise, on a price triggered, you're simply going to experience maximum potential profit or maximum potential loss, one or the other, whether you bought or sold it and whether it touched the floor or the ceiling. All right, so hopefully everyone's clear on that. It's pretty straightforward. It's a Delta One product. You are buying, you're trading the price of the underlying. If you think it's going to go higher, you buy it. If you think it's going to go lower, you sell it. And you've got these clear predetermined knockout levels, the floor and the ceiling, and if it doesn't touch one of those during the time frame, it will settle at the end of a time frame. So, as I mentioned, each knockout has a duration of 1 week, and at the beginning of the week, we'll generally list 4 knockouts for each market. Now, we offer knockouts in equity indices, commodities, and foreign exchange, FX, Forex markets. So you'll have these products, and for each one of them, there'll be 4 knockouts. And in the event that the floor or ceiling is touched, which in all likelihood it will at some point early on in the week, that knockout is settled, it disappears, and a new knockout is listed, so that in most cases and in most market conditions, there'll always be 4 knockouts for you to choose from. And I'll explain why in a bit. So let's walk through a simple example, and here is the US 500, the S&P 500. All right, you think you're going to trade the S&P 500, and you're going to go take a quick look over at our knockout contracts. So when I did this example, this is just an example, the S&P trading around 2720, and we had 4 knockouts. Now, our knockouts all have a predefined range. You would have to look, we can show you the contract specs on what that range is and what the value is, but ultimately we do all the math for you on the order ticket, so you don't need to do all the math to understand what range the knockouts are going to be in, or what your potential profit or loss or any of that. It's calculated for you on the order ticket. We make it very simple for you. But let's just walk through this example. There are 4 different knockouts, and I've got the math up there, but the floor, for knockout 1, the floor is 10 points lower and the ceiling is 40 points higher, so there's a 50-point spread. For each one of these knockouts, there's a 50-point spread, just at different levels within the market. So here we are at 2720, and let's take a look. What happens if the S&P 500 were to go higher? Oh, and here, by the way, the red line is the end of the week. So now the S&P is going to go higher, and it starts trading higher, and noticed, boom, it actually touched the ceiling of knockout number 4. So knockout number 4, which was the lowest knockout, the lowest level knockout, the ceiling of it got touched, and knockout 4 is knocked out. That contract is going to settle. If someone had bought that contract, they would just experienced some profit. If someone had sold that contract, they would just have experienced some loss, and they're out of the trade. Now, because knockout 4 is gone and we're going higher, we add a new knockout that goes a bit higher. So if you stack these, we would have 4 knockouts that sort of look like the original positions that I had shown you. Now let's go through if the S&P 500 had gone lower. All right, notice when it goes lower, the knockout number 1 had the highest floor, right? So boom, knockout number 1, the floor just got touched and it got knocked out. If I had bought this knockout, I would just have gotten knocked out for maximum loss. If I had sold it, I would have made maximum profit. But I'm gonna go through some examples so you can visualize what all that was a little bit easier. But now knockout number 1 is gone, and we add a new knockout down below. Pretty straightforward. This is all automatic, and on our charts, we make it easy for you to see what levels the knockouts are at. Oh, and someone's saying, how do you know which number the knockout is? I'm numbering these knockouts. I'm calling them knockout 1, 2, 3, and 4. But really what you're going to see are knockouts, and you're going to see the actual floor and ceiling. So when we identify our knockouts, we tell you on the contract, this is knockout is with this floor and this ceiling. And also on our charts, you can visualize it. We show it to you. I will get there because I want to walk through the concepts of it. I think it should be pretty intuitive when we get over to the platform. Now, I mentioned there's a time triggered settlement, And I'd already gone through this, that if, with a knockout on price, exactly if it touches the floor ceiling, what you could potentially make or what you could potentially lose. With a time triggered, it's the difference between where you bought and sold it and where it settles. So if I were just to go through a little example with the same type of picture, you can see, for instance, knockout number 4, it never got anywhere near the floor or the ceiling. And so it would have just settled the difference between where you bought and sold it and where it settled. Now, let's talk a little bit about knockouts and why do we have knockouts? And it's really around the risk reward relationship. Now, people love the binary options. They are much smaller dollar contracts. They're maximum of $100, and you're trading the probability. As you can see, our knockout's a little bit bigger. They're a few $100s, but they're also much more intuitive. You're buying or selling. You're trading the actual price of the underlying. And what it does is it essentially gives you a built-in trading plan. It forces you to have an exit strategy, right? Because you know your maximum risk and your maximum reward, potential risk and potential reward before the trade is placed. Those knockout levels give you natural either profit targets or defined risk targets. So you think about it, if I buy a knockout, all right, my profit target is it gets to the ceiling. It's got an exit strategy. If I buy a knockout, my exit strategy initially is going to be, I bought it, I'd love to see it hit the ceiling. I've got maximum potential profit, and if it got up there, I would take my profit and move on to another trade. It also has a natural stop loss. If I bought it and I'm wrong, the markets can be unpredictable. I could have done a bunch of analysis and simply misinterpreted it. Something could have happened, but I'm clearly wrong and it went down. It's going to force me out. It's going to knock me out of my trade and force me out of my trade and take my lumps and take my losses, which essentially it's making you be a little bit of a disciplined trader. So for brand new retail traders, and I mentioned that these products are built for retail traders, it's like having guardrails on your trade right away. We've pre-packaged a product where you can trade, and it's going to have a stop loss baked into it, and it's going to have an exit profit taking goal baked into it. Now, if I thought something was going to go lower and I sold it, all right, my maximum profit goal, what I'm looking for is it hit the floor. I sell it, it goes down to the floor, I'm knocked out, it's going to take me out of my trade and I'm going to experience maximum potential profit. If I sold it and I'm wrong and it goes up, it's going to force me to get out of my trade. And that is actually one of the most difficult things for retail traders, is to either, one, take their lumps when they're wrong, or two, know when to say, thank you very much, I'm going to take my profit and move on, right? And that is that's a challenge. A lot of retail traders, it's, you simply, people tell you to have a trading plan. They advise you to have a trading plan saying, all right, when you go into a trade, let's think about where is it that you'd be prepared to get out for a profit, and where would you want to take your losses if you were wrong. With a knockout, we do that for you. It is baked into the product. Now, I can go through the math. I'm not going to go through because we showed this all to you on the order ticket, but your risk is, if you sell it, right, your risk is it goes to the ceiling, right? And you sold it and it goes to the ceiling, that's going to be your risk. If you buy it, your risk is going to be if it goes to the floor, right? And your reward is the exact opposite. I think I've gone through this, but mostly I put this in here just so if someone's going back and reviewing this, you can see it visually. We put it in words, but ultimately it's on your order ticket. We do the math for you, and you can actually see it. And on the charts, it is very visually easy to see as well. All right, now, I would like to go through, and I mentioned that I would make it a little bit visually easier for you to see your risk reward and how some retail traders, how they tend to look at which knockout do I want to trade? What is it that I'm looking to do? Which ones would I potentially want to buy and which ones would I potentially want to sell? And it all depends on your anticipation of what's going to happen, right? You've got to pick, if you think something's going to go higher, you would obviously buy a knockout. If you think it's going to go lower, you'd sell a knockout. But then you've got other levels in there, and you can determine how much risk are you comfortable with, and what kind of reward are you looking for, and what type of risk reward ratio are you looking for in the trade? And each trade, that's why we give you 4 different options, because the 4 different options give you differing levels of risk and versus potential reward on your initial trade setup. So let's take a look at knockout number 1. Knockout number 1, if you were thinking the S&P were going to go higher, this might be the one that you would want to choose. Why would this be the one you might want to choose? And that is because if you're wrong, it's got the tightest stop loss level. The floor is the closest to where we are. That's the one where it gives you the most runway if you're right, and you could get potential profit, and it forces your stop loss to be tight. Now, knockout number 2 might be a good option as well if you're prepared to take a little bit more risk, because remember, these things move around, and if you're so close to the floor, it can move around, it could touch the floor, you get knocked out, and then it takes off, and you go, oh my God, I had my risk in a little too tight. Every trader's got to determine how much risk they're prepared to take. So you've got to choose which knockout suits you the best. Now, to visually see this, let's take a look at knockout number 1. All right, here's the S&P 500. Here's where you're buying it. Here's the end of the week. We know where the floor is, right? We gave you the floor. We also gave you the ceiling. These are pre-built into your contract, and you thought it was going higher, or in this example, we thought it was going higher. You're buying it. So if you buy it, ultimately you want the price to go up, right? Now, your stop loss is down to the floor. The loss is that red zone, and the green is your profit zone. This is why we give you 4 different knockouts. You've got to determine what ratio of risk, the red, to reward, the green, you want in your trade. And so, could someone sell this particular knockout because they thought it was going lower? They could, but their potential profit is small. Because if you sold it, your profit would be in the red. And if you're wrong, that green would be where you lose. So it would be a little odd to sell this one when you had other choices to choose from if you thought this were going lower. So really, when you see it's close to the floor, it tends to be knockouts that people are looking to buy. And when the price is closer to the ceiling, it tends to be knockouts someone wants to sell. So this is the example of a buy. You look at knockout number 1. And as I mentioned, knockout number 2 might be the better one for you to trade. Maybe you're prepared to take a little bit more risk, but you do limit your reward a bit. Now, if you thought it were going down, all right, I think the S&P is going lower. That might be knockout number 4 that you would potentially choose, or number 3. But let's look at what happens there. Here's the same chart setup. I know where I am at the beginning. I know where I am at the end. I know the floor and the ceiling, and I'm selling it. I think it's going lower. My risk is if it goes higher. That is when people sell a knockout, they tend to choose ones where it's near the ceiling. Again, how much of a stop loss level do you want to have? How much risk am I willing to take for what level of reward? So again, the reason that we offer 4 knockouts is for you to choose the right risk reward relationship. All right, for you to choose the right risk reward relationship, and it also benefits you on capital requirements. And I sort of got ahead of myself right there. And I want to talk, what does it cost to trade one of these? And because you know what your maximum risk is when you initially place the trade, that is how much you have to put up. right? That's how much it costs to put up the trade. You have to put up the most that you could potentially lose. This is also why we offer 4 contracts. So you, if depending upon how much capital you have to trade with, how much money you have to trade with, you can manage how much money you're putting into the market by simply limiting the amount of risk you take. Now, your initial, what you pay to trade one of these is your maximum risk. End of story. There are no margin calls ever. You initially put up what you could lose on the trade, and that is it. No one's going to come back to you looking for more money like happens in other futures markets. You've put up your maximum risk, that's it, and your trade is on. And as we mentioned, these go out a week. So if you put it on a Monday, you're into that trade for an entire week or until it knocks out. If it touches the floor or the ceiling, you're knocked out. That's it. And then you would, if you wanted to continue the position or to put it back on, you could trade a different knockout. And because it's the risk is known whether you're buying or selling, right? I buy it, I know what my maximum risk is, it goes to the floor. I sell it, I know what my maximum risk is, it goes to the ceiling. It doesn't matter. Buying or selling, your maximum risk is known. That's what you have to put up. That's the collateral that you have to put up. And there's never a margin call after that. And we offer multiple products. And that's why we offer 4 knockouts so that you can choose how much you're willing to put at risk. Right. Hopefully that all makes sense. Really great products. If you want a Delta One product with a pre-built essentially trading plan baked into it, it forces you at a price to either be knocked out for a profit, knocked out for a loss, or it expires at the end of the week. Now, I want to quickly go over an order ticket because some folks were asking, how do you know if you're trading knockout number 1 or knockout number 4? And really, here on the order ticket in the upper left-hand corner, this is on the NASDAQ. All right, here's an order ticket for the NASDAQ. In the upper left-hand corner, it tells you the NASDAQ, the US Tech 100 is trading at 13,074. This is how you know which knockout you're trading. All right, it actually tells you you're trading the floor of 1352 to a ceiling of 13202. Now, I could see that on the order ticket. You will very clearly see that on the charts. When I get over there, you will see it. We show it to you. We make it super easy for you to choose between which of the 4 knockouts. And in fact, sort of like I had on those examples where we had 4 of them stacked, we've got those 4 stacked on the chart for you to click through and choose which one of the 4 you like the best. Now, you will have a market. There's a bid and there's an ask. Those are the prices where you can sell or you can buy. Notice that the bid and the ask, the prices are right around the price of the underlying. So notice that the indicative price, 13,074, drops right in between these prices. Now, do you have to sell on that 1372 and a quarter or buy on the 1374 and 75 cents? No. You can actually put a bid or an ask in between the market or even away from the market. I could bid below, I can offer above, I could place a bid or an ask in between the market. Now, does it mean I'm going to necessarily trade at my price? No. I could expose my order to the market. I could say I'm willing to buy or sell in between, and somebody else may want to trade with me, but no one has to trade with me. But if you really wanted to execute the order, you could try to buy at the offer or sell at the bid. Notice those 2 little numbers in you know what, there's a 25 and a 20 in the corner of the order ticket. That's how many contracts are bid for and how many are offered. If you wanted to see market depth, there's a market depth button. Now, you can place your order in between the bid-ask spread. So here I'm actually clicking, you can see it's all blue. I'm actually trying to buy. If I were trying to sell, the red cell would be lit up. So you know whether you're buying or selling. And I am, in this example, I would be trying to put a bid 13,073.50 in between the bid-ask spread. Now, will I buy it there? I don't know. But can I place a bid there? Yes. And I know before I place my order what my maximum potential profit or loss are if one of the boundaries, whether the floor or the ceiling is touched and I get knocked out. If I bought this at 1373.50 and it traded down to the floor of 13,052, I would get knocked out and I would experience an $86 loss. If I bought it and it went up to the ceiling, I would get knocked out for maximum profit of $514. Notice our NASDAQ spreads are $600 contracts. The S&P 500 ones are 500. They're all a little different. There are subtle nuances to the knockouts, but again, you can look at the different contract specifications, but it's also on the order ticket. You'll see that clearly on any order ticket. Okay, now that we've gone through knockouts, all right, hopefully, and I think I've answered everyone's questions so far, and when I get to the charts and the platform, I think everyone will really, I'll drive home a lot of what we've talked about. Now that you understand knockouts, I think call spreads are going to be relatively easy. All right, we don't have to spend that much time with call spreads. So let's go through what call spreads are, though, quickly. It is also a contract that has a predefined range. And that range, just like in knockouts, is called the floor and the ceiling. So far, they're identical. And the value of a call spread will move in line with the underlying, very, very similar to knockouts. However, all right, and this is where the big however, call spreads differ from knockouts in two very distinct ways. All right. Number one, a call spread only expires at expiration. It is only a time triggered settlement. There is no price triggered settlement with call spreads. Okay. Now, that means you are not knocked out if it touches the floor or the ceiling. Okay. A call spread only goes to expiration and only has settlement at the end. It is only a time triggered settlement. Now, what does that do? That gives you optionality. Okay. That means if I bought it and it were to hit the floor, I'm not knocked out. I've got more time to be right. It could trade a little bit lower and then it could trade higher and I could potentially profit, right? So some people like that. It's not a hard and fast knockout, but because there is optionality in a call spread, time to expiration and volatility will impact the price. There is going to be a premium. So when you trade a knockout, it is a Delta 1 product. It is going to move directly in line with the underlying. The price of a call spread will be impacted by volatility as well as time to expiration. In a very low volatile environment, very close to expiration, a knockout and a call spread will be pretty much identical. But early in the week, because there's a lot of time, that call spread's going to have some premium in it. And if it's really volatile, there'll be more premium in it. So that will impact the price of a call spread. All right, so I'm going to go through the risk reward on buying or selling knockouts. Okay, I will go through because you're trading the price of the underlying, and then if it ticks around, I'm going to go through the profit and loss on a knockout, as well as the price and profit and loss on a call spread when I jump over to the platform. It'll be easier. I mean, I'm talking about concepts right now. The math of it, and so you can really see what happens. It's actually much more intuitive when I do it on the platform. So, and I'm going to spend a good 20 minutes on the platform so everyone can see. I just want to walk through an order ticket on a call spread. And the reason I do this is so that you can see the difference between a call spread and a knockout. All right, when I grab this image, the indicative price of the Nasdaq was trading 13,070. All right, 13,070. Notice the prices that you would trade. If I wanted to buy it, it's not right at 13,070. It's all the way up at 13,114. That is the premium that is baked into it, right, in this call spread. And notice that the call spreads for the Nasdaq, the call spread's it's a $500 spread. Notice at the bottom, again, it gives you the floor, it gives you the ceiling, all right? And I was buying one right near the floor. It gives the same bid-ask spread. Now, if I wanted to buy it, even though the indicative price of the underlying is 13,070, the price I'm trying to buy, 13,112, that's the price that I'm trading for the call spread. I'm paying a premium, but that's because I've got the optionality and I know what my maximum potential profit and loss are baked in there on the order ticket. Okay, and I think a lot of this will be much more intuitive, not only on the charts, we also shade the charts so you can tell if you're selling it, if you're buying it, and all the math is done for you. Now, before I jump over to the platform, if you take nothing else away from today, alert, alert, alert. I hope I've got everyone's attention. This is really important because this is an important concept, whether you're trading binary options, call spreads, or knockouts, okay? But specifically, because today we're talking about knockouts and call spread, just because there's an expiration associated with the contract does not mean you need to wait until then to see what happens. You know, just because a knockout has distinct knockout boundaries, a floor and a ceiling, you do not have to let it trade until it touches the floor or ceiling and knocks you out. You do not have to wait until time expires if it doesn't touch the floor or ceiling. Or in a call spread, more importantly, when people trade call spreads, you do not have to wait until the end of the week to see what happened. You can choose to exit the position early, all right? And that is absolutely critical. You can choose to exit the position early. Now, with knockouts, you've got these clear knockout levels that are going to force you out of the trade, but you can always choose to exit early. And why would you exit early? One, to lock in profit. All right, I bought a knockout. It went higher. It hasn't touched the ceiling, but I'm willing to take the profit that I got. To exit the position, I would simply sell it back. I sell it back out. If I bought it and it went up and I sold it at a higher price, I would experience some partial profit. I don't have to always wait and look for maximum potential profit. I could also do it to limit losses. I bought one, it started going lower. Maybe I didn't put my floor in, I didn't choose the right one, and it's clearly going lower, and I want to stop my losses. I don't want to wait till it touches the floor and gets knocked out. I could simply sell it and experience a partial loss. All right, so, and if you're selling one, all right, I sell a knockout and it goes lower, I don't have to wait for it to touch the floor and get knocked out for maximum profit. To unwind that, I would simply buy it back. I sold it, I've got a short position, it went down, I want to take some profit, I buy it back, thank you very much, move on to your next trade. Conversely, you can limit your losses. I sold one, it started going higher, I changed my mind, I don't want to experience maximum loss by having it touch the ceiling. I could buy it back at a higher price, experience a partial loss. Now with call spreads, it's almost invariably that someone is going to close the position before the end of the week. If someone puts the position on a Monday, in all likelihood, I mean, it's trading around. You buy a call spread, it's got a premium baked in there. Now, interestingly enough, with a call spread, because you're not knocked out, you've got to be paying attention to the market. A knockout, you put that position on and you go and play golf or you go to the grocery store, you know that if something were to happen and there were some big move, if it were to hit the floor ceiling, you're knocked out and you're done. That's it. And you either experience the profit or loss. You buy a call spread and it goes up and it goes through the ceiling. Hey, this is great. It went the right way. You're not knocked out of that trade. You still have that position on. Can you make any more money? Maybe a little bit. There's still a little premium in there, but you're up there. Now, to take your profits, you would have to sell it. You would have to sell it and say thank you very much and take your profits. And if you're not paying attention and you don't have an order to sell it higher and it goes up there and it's great, and then it comes back down, all your profit would disappear and you would have actually had the right position, but you didn't take the position off when you had your profits. So a call spread, you're going to have to be paying attention a little bit more. Now, remember, you can put orders away from the market. If you buy a call spread, you can put an offer to sell it higher. And if you go away and it were to get up there, your order would still trade, you'd sell it and you take your profit. But if you didn't do that, it could go up there and you could have missed your opportunity to take your profits. So you've got to be paying a little bit more attention so that optionality on a call spread, it works when you're wrong. All right, I sold one. I think it's going to go lower, but it went up and it drifted through the ceiling. I'm not knocked out. I'm losing on this trade, but I have time to be right for it to come lower. That's great until it goes way lower, and then you don't buy it back, and it goes all the way back up again. So the call spreads, you've got to still manage them a little bit more, whereas the knockouts, clear, distinct levels where you get knocked out. But this is an important rule. Just because there's an expiration associated with it does not mean you need to wait until then to see what happens. I want to mention, if you haven't taken advantage of this, we do have our Refer a Friend program where you can invite your friends to come to Nadex, right? And the way our Refer a Friend program works, you give them your personal link, they sign up. If they do 5 trades within 30 days of applying for their account, we'll give them $100 and we'll give you $100. So, you share the wealth. If your friends aren't on Nadex, you're here and, they wanted to get involved, it's a way for you each to get $100 is come over to Nadex and give it a shot. You can do that with up to 10 friends and you can earn potentially up to $1,000 in your Nadex account. All right, if at the end of this, I have not answered everyone's question, we're going to go over to the platform in a second. Please email us, customerservice@nadex.com. We are here to help. We want to see you successful. If you've got any questions about our products, the markets, your account, please email us. We can't help you if you don't reach out to us. And follow us on social media. While we've got all of our social media channels, I will highly recommend that you follow us on YouTube. Every morning from 8:45 to 9 a.m. Eastern, 8:45, 9 Eastern. So in Central, it's 7:45 to 8 a.m. Central. We live stream analysis. What happened overnight? What's the news that's going on in the markets? And where are hot spots that you might want to take a look at where there could be potential volatility or potential opportunity? We even do a little bit of technical analysis, live streamed on YouTube every morning. And so if you need a little help just kind of knowing where you should look or where you could potentially look for opportunity, we're not telling anyone what to do and what to trade, but it kind of catches you up to speed and gets you ready for the trading day on some places that you might want to look. Follow us on YouTube. I would recommend it. Plus, the recording of this will be there as well. Okay, I want to get over and do the off-roading for knockouts and call spreads. I want to make sure everyone understands and they get this. I think this will really help. It will solidify everything that we've just discussed. So I am now jumping over to the Nadex platform. Okay, good. And again, if you've got some questions, you again type them in, but let's start with knockouts. Okay, so on our markets, little section over here in the upper left-hand corner, all right, I'm going to open up markets. We've got our products, binary options, call spreads, knockouts. I'm going to start with knockouts. In knockouts, you can see we've got equity indices. All right, we've got foreign exchange markets, all right, all the major pairs. So you can choose any one of those if you like to trade Forex. And we've got commodities. The two big ones, crude oil and gold. In fact, we're going to be doing a boot camp on trading the gold and oil markets where we'll walk through our products specifically around gold and oil, but you'll also learn some other things like trading around news events or even fundamentals. I think at the end of the day, my colleague over at Daily FX is going to do an entire thing on the fundamentals of the gold and oil markets, what you could be looking at, what reports are out there, things to help you trade those markets. So yeah, you can register for that on the Nadex website. So I am going to let's stick with indices, and I'm going to use the S&P 500. When I open it up, you'll notice there are 4 knockouts right here on the chart. 1, 2, 3, 4. Now, when I click on them, it's going to go over, and I'm going to hide this now. This is what I meant when you can see the different knockout levels. We've got these 4 bars on the left-hand side, and you can see knockout number 1, knockout number 2, knockout number 3, and knockout number 4. All right, and the floor and the ceiling are clearly and distinctly marked on the chart. So if I thought the S&P were going to go lower, this knockout number 4 might be the one I want to choose. If I clicked on sell here on the chart, notice how it makes it red over here. And I know if I were to sell one, all right, now let's pick a price. Look how tight these markets are, 30, 40 cents wide. I'm going to sell one at 41.69.70. All right, I'm going to put one a little higher. And I'm actually, notice how this is between the bid-ask spread. If I thought it were going to go lower, I'm going to place that order. Now this is a demo environment. You could see the 41.69.70 offer went in. Now, am I going to trade there? Someone will have to buy it from me. It's getting close. Now, what could I potentially lose? I know that the most I can lose is $83. That would be the capital requirement I have to put up. And what would happen if it went up to 41.78? I would get, and look I've got that position now. It's on. I did sell it. All right, I sold one at 41.69.70. It's going up. It's going the wrong way. I mean, we're in a little uptrend here. Again, not a buy or sell recommendation. I just wanted to show you an example. I know I could only lose $83. If it gets up to the ceiling, I would get knocked out and lose $83. That was my capital requirement. That's how much I had to put up. Now, what would my potential profit be is if it came all the way down to 41.28. All right, I would get knocked out for maximum potential profit of 417. All right, that's a knockout. All right, now, and I just took a short position. Now, could I go buy it back right now and take a partial loss? All right, I could buy it back. I sold it. We know I sold it at 41.69.70. If I bought it, I could take a $3 loss right now and just buy it back. In fact, it tells me that's what would happen. If I just bought the offer, I would lose $3. I'm going to leave that short position on. Now, do I have to wait for it to come down to 41.28 for me to potentially profit? No. Maybe I'd buy it back, and I'm just going to look at the chart here. If it went to 41.54, if it came down to 41.54, I'd buy it back. So I can actually go in and put 41.54. Okay, this is below. All right, this is well below this price. But if it were to come all the way back down to 41.54, I would buy it back. I'm going to place my order. And notice down in my positions pane 1, I sold it up at 41.69.70. I would get knocked out if it went up to 41.78. I know that that's where I would get knocked out. But if I'm not paying attention and it were actually to dip and it were to come down to 41.54, I'd buy it back and say thank you very much. Okay, and I would just take a profit down below. All right, and I just picked a price. All right, not a trade recommendation. I'm just showing you how that would work. I just did it from the short side. Now let's pick the buy side. Let's pick a different market so I don't confuse this. Let's go ahead and take a look at oil. I'm going to go to oil commodity. Let's click on crude oil. It doesn't matter which one I pick because it's going to bring up the chart, and I could take a look at. Oh, I didn't mean to do that. There we go. I can take a look at the chart and I could see my 4 knockouts. What do I think oil is going to do? Maybe I think oil is going to go higher. All right. I think the economy is going to recover. All right. I'm going to look at this is the closest knockout I've got. All right. This is the closest one with the floor. And if I wanted to buy oil, all right, and I think oil is going to go higher, and I'm going to try to buy it at 61.56. All right. I'm going to place my order to buy one. There's my bid. I might buy it. There's 61.56. I know that the most I could lose would be $156. In fact, I did buy it. You can see in my position page, I actually bought it there. Now, if it were to drop down to 60, I would lose $156. If it were to get all the way up to 65, I would make $344. Now, I bought it at 61.56. I know I'm knocked out at 60, but maybe I would sell it back for a profit if it went to here. Where look at this, there's this big down spike from Tuesday. Maybe I think it's going to get back there. Remember, I've still got 1 day and 1 hour. This settles on tomorrow. Tomorrow's Friday, today's Thursday. So if I wanted to sell it here at 63.46, all right, I think it's going to go, if it gets up to 63.46, I'd sell it back. I can put in 63.46. Oh, I want to sell it there. So hold on. Make sure you do that. 63.46. Make sure I've got sell in there. All right. I can place an order up above. All right. Notice that's way above here. I can place that order. Now, I've taken a short position in the S&P 500 and I'm losing, but I know I get knocked out if it keeps going higher. I've taken a long position in oil and I'm losing, but I know that I'm knocked out down below. But each one of them, I've changed my profit goal. Not so with the S&P that I bought, the S&P that I sold, right? I'd buy it back lower. The gold that I bought, I'd sell it out higher. I'm not necessarily waiting for this oil contract. I bought oil. I'm not waiting for it to get all the way up to 65 to experience maximum profit. I'd sell it if it just got to 63.46 and say thank you very much. All right, so I think that covers knockouts, and they're very clearly marked and how I can place an order between the bid-ask spread and what I'm trading. Notice how the price of a knockout moves directly in line with the underlying. 61.53 right between the bid-ask spread. And my ceiling and floor are clearly marked on the charts. And if one of these gets knocked out, a new one will show up and you'd have a new blue line. If it got knocked out because it went higher, this bottom knockout would disappear and we'd add one up above. If it went lower, this one would get knocked out, right? Because it touched this floor, and we'd add another one lower. Now let's take a quick look over at call spreads, and I'll just do one example over here. Let's just pick a foreign exchange market here. Let's take a look at the euro. Now notice how we've got different times on call spreads. We've got hourly call spreads, we've got daily call spreads, we've got weekly call spreads. Knockouts, if you notice, they're all weekly. They go out for the whole week. They get knocked out. We add a new one at the end of the week. The last 4 that are left settle, and we print new ones. With call spreads, you've got new ones every couple hours, every day, every week. So let's take a look at the euro weekly, the euro pound weekly. I'm just going to pick one of them. Again, I'm going to hide this. Now, we shade the floor and the ceiling of the knockout. So you can see this knockout is distinctly dark blue. This is the one I clicked on. And if I'm buying it, this is the range, it's blue. Now, if I were selling it, watch, it lets you know that you're selling it. Now, what call spread do people choose? A lot of times they look for, if they're going to sell one, they want to have one where, just like the knockouts, where it's close to the ceiling, or if they're going to buy one close to the floor. If you want to see the different ranges, and we've got different ranges, you can click through each one to see. Here's one where we're near the ceiling. Just above it, if I wanted to take a short position, I could potentially sell this. It's got 1 day and 1 hour. All right, I've really got this. If I were to sell this this call spread, if I were to sell this call spread, all right, the most I could lose is 11 bucks. And notice I'm selling it, it's already above. It's already above here. So I mean, it's got to come lower for it to even get into the profit range. But if I thought the euro were going to get really weak against the British pound, so I think this is going to go lower, I could sell this, and yeah, if it were to get all the way down here, maximum profit would be 239. And again, if I sold it, I wouldn't have to necessarily wait for that. I could sell it and just buy it back if it came lower. Right. So with call spreads, you've just got to take a look, and the easiest way to do that is clicking around on the different call spreads and see what ranges they're in, where the floor and the ceiling are, to help you determine whether you want to buy or sell them. And if you're clicking buy, it's going to shade in blue, and if you're clicking sell, it's going to shade in red. All right. All right. With that, I think we've gone the full hour. We have covered knockouts, we have covered call spreads. This was recorded. You can go back and review it at your leisure. You'll find that again on the Nadex website under Learning Webinars Archive. It will also be located on our YouTube page. I cannot encourage you enough to follow Nadex on YouTube and check out the content that's there. And I would highly encourage you to listen to those morning analysis sessions and probably maybe join. They're only 15 minutes in the morning. We do stream them live, and if you miss them, the recording is immediately available. If you want to go back, you can play the recording from this morning and hear what we were talking about. But it will help you identify potential hotspots in the market for the day. With that, I want to thank everyone for joining. Again, if you have any questions, please email us, customerservice@nadex.com. And I want to wish you all good luck in the markets. Thanks, everyone.